SA Foundation. Siyathemba nizolijabulela lolu hlelo.
Siyabulisa bafundi baka Matikuletsheni umatric with isifundo sethu se-accounting namhlanje. Siyaqedelela ke i-topic kade besiyenza last week yama ratios. Uzokhumbula ukuthi last week siqale ngama topic yama ratios with i-profitability and efficiency ratio. Those are the 5 ratios there on the profitability and efficiency ratio. And then we went to the liquidity ratio. Maybe if you can just recall on the profitability and efficiency ratio, gross profit on sale, gross profit on cost of sales, gross profit on net profit after tax, and net profit before tax. But don't have to cram those ratios. Those ratios, the formula of the ratio, the formula of that ratio is on the ratio itself. The only ratios that you must know, it's a liquidity ratio. There are 6 ratios there in total. Remember, just to remind you, ratios, set liquidity ratio. Liquidity ratio. What is liquidity? We said liquidity occurs whereby the business is having problems in a short run. So that is the definition of liquidity. Occurs whereby the business is having some challenges in a short run. And there are about six ratios in that group. We have current ratio, right? Remember last week we said what is current ratio? We said current assets is to current liability. Current liabilities. Right, everything is to 1. So you calculate the prefix. Everything is to 1. Okay, then we go to the commentary after maybe getting our returns. And then we have also on the same ratio, just to recap quickly, we have acid test ratio, acid test or quick ratio. So we are saying here current assets less inventory is to current liabilities. Current liabilities, something is to 1 even there, but we'll come back to the commentary. Okay, right. Okay, and then you calculate only the prefix or the left hand side. The right hand side will be always is to 1. And then these ratios are friends. As you see, there's a lot of ilokuzana, ama similarities between the two. Remember, there are 6, right? And then we've got another one called stock turnover rate. 3, stock turnover rate. Stock on turnover rate. We said average stock, average stock divided by average stock is it's average stock divided by the cost of sales. Right, average stock, so it means you take stock for last year plus the one of this year. That is an average. You divide by 2. So let me just make an example. Remember last week we said, let's say 2020 amount plus 2021, right? You must divide this by 2. You divide by the cost of sales. So the answer is something time. And then we go for now the friend of this one again, that is stock holding period. Stock holding period. Stock holding period, what's the formula there for the stock holding period? It's very simple. It's an opposite of the stock turnover. So which means here we're having what? Cost of sales, right? Cost of sales divided by average stock. Average stock, right? Times by 366 or 365 over 1. Remember, last year it was a leap year, grade 12. After 4 years, after 4 years, seen a leap year, we look at our FEP. Our FEP this year, our February is going to end on the 28th, not on the 29th. So the answer here is days. Days. So the answer here is days. And then we've got another pair of the ratios. That is also angama friend. 5 debtors collection. Okay, debtors collection period. Debtors collection period. So the formula here is what? Average debtors. If you are saying average, you are saying the debtors of last year plus the one of this year divided by 2. Okay, average debtors divide by credit sale times by 366 over 1, right? So the answer is something days. Remember, sometimes ama credit sale grade 12 ngeke uwanikezwe like to a credit sale. Maybe you'll be given ama cash sales with a split. Something babhale kanje back. Maybe they will do this. Okay, maybe they will do this. They will say they will give an extract of the income statement. Maybe they will give you in this format. They will say sales, right? Cost of sales, gross profit. Okay, maybe you'll be given a briefly income statement. And then in brackets, maybe they will say 40% cash. And then they give you a figure maybe of 15,000. You see? So which means the credit sales here, it's what? Is 60% because of cash. 40. So which means these are total sales. So we are saying now 15,000 times by 60% divided by 100. So which means our credit sales will be 9,000. You can see that. Okay, that's how we must calculate the credit sales. Sometimes we won't be giving. Okay, so your answer is something days. And then the last one on this group will be creditors repayment. Okay, the creditors repayment. Creditors repayment. Why is the creditors repayment? Remember, our debtors abantu abasikweletayo. So that's why it's a debtors collection. So we have to collect from them abantu abasikweleta. So la siyakweleta thina, so we have to pay. It's a creditors payment period. Right? Average creditors divide by credit purchases. Credit purchases. Also nakhona uzothola ukuthi unikezwe ama total purchases maybe with a particular percentage, and therefore you must do like you were doing on the credit sales. Okay, you won't be given. We are trying to ukuthi ngikhumbuze ukuthi last week senzeni quickly before we start the work. And then sizoya manje kuma ratios. Okay, saya ma ratio we risk. Remember saya kwi risk. I-risk is only one ratio. I-risk ratio, right? Only just one. Quickly, on the risk ratio, it's just only one risk. To calculate which ratio, this is a debt, equity equity ratio, or we call it a risk ratio, right? Okay, that is a risk ratio, right? That is a risk ratio. Then the formula is non-current liability, non-current liabilities is 2 note number 7 plus note number 8. What is note number 7 and 8? That is the shareholders equity. Shareholders equity. So these two, it's shareholders equity. That is capital plus retained income. Shareholders, share equity, sorry, share equity. Share equity. That is a share equity. That is note number 7 plus note number 8. So, which means here we'll be having 3 figures. Is this figure here, and that figure, and that figure here. And then you get your answer, something is to 1. Right, so we're done with the risk. But there will be a question that we'll be doing towards the end of our lesson. In note number 7 and note number 8. And then, see with solvency. See with solvency, right? See with solvency. Solvency. What's the definition of the solvency? Occurs whereby the business is having the problem in the long run. Remember, illiquidity occurs whereby the business is having problems in a short run. So it's an opposite. So here's Tini. Total assets is 2 total liabilities. Into enhle ke esiyenzeka manje grade 12 ukuthi ama formula usiyowanikeza towards the end of your question paper. Kanti besinganikezwa all these years. Aqale from last year. 2019 was the last group which bangathola ama formulas, but as from last year now, since they are counting this paper 1 and paper 2, usuyakwazi ukuthi unikezwe ama formula. Kodwa into enhle kuba kuhle ukuthi uwazi ama formula noma ngathiwa uyinikeziwe kodwa ukuthi at least kwasawena you are clear, because awekho difficult. So something is to 1, then you get a solvent. And then again now we'll be looking at the ratios called the earnings. The earnings. If you earn, you are earning what? Imali, right? That is or cents, you see. So that is earnings. The earnings. So these are earnings. Azobuzwa ke ama ratio ke grade 12. Into ehle ngama ratio akhona paper 1 akhona na paper 2. So that's a ufuna wenze sure ukuthi uya capitalize ke lapho ngoba, which means if awazi paper 1 azophinde futhi akushaya futhi paper 2, right? The earnings, there are only 3 ratios on the earnings. Number 1, remember you are allowed to abbreviate on the ratios, and you are not supposed to write the formula on the ratios, right? We know the formula. You are also you'll be given also the formula at the back. What when I was supposed to do is to write the figures that are in line with the formula. Kufuneka ubhale ama figure ahambisana neformula. Hayi wena ukuthi ubhale iformula. Iformula ungayibhali, it's a waste of time. Bhala ama figures. Bhala i-ratio, ubhale ama figures accordingly. For instance, njengoba ngithi lapha njena we're doing a solvency. So we're going to write total assets, figure, total liability. Something is to 1. You go to a risk, right? You'll be saying non-current liability, normally it's a loan, right? Or mortgage bond or mortgage loan. Plus note number 7 wako capital, plus note number 8 wako retained income. You see, if lama figures lawa sehlanganisiwe, just write that total amount and then you divide something is to 1. Don't write the formula. You can write the formula if you are at home, usekhaya, or you practice noma useklasini. But once you are in an exam or in a test, don't waste your time in writing the formula, right? So sinama ratios awu 3 ke ama earnings, right? Yoqala sithi earnings per share. Earnings per share, we call it EPS. EPS, okay, I'll skip the point here because the khona ama similarities akhona. And then it be khona ini DPS, earnings per share, dividends per share, sorry, dividends per share, dividend per share, we call it DPS. You can even write DPS. No one is going to punish you if you write DPS. And then the last one, sine net asset value per share. They call it NAV. Okay, these are the earnings, grade 12. These are the ratios, we call it AMA earnings. The question, if the question is saying comment about the earnings, these are the earnings. If the question is to comment about the risk, this is the risk. This is a formula, this is the risk, debt equity ratio. If the question is saying comment about the liquidity, position of the business, they are talking about these 6 ratios that we're counting. Comment about liquidity position of the business. You see, they are talking about current ratio, acid test ratio, stock turnover rate, stock holding, as well as debtors collection and creditors payment. Those are the ratios. But now we are here on the earnings. What is similar lama ratios lawa or matatu? Number 1, the first similarity here is what? It's a denominator. Ya wonke lama ratio lawa. Denominator yakhona iyafana. Denominator yakhona. Number of shares. Okay, number of shares issued at the end of the number of shares issued at the end of year. Right, number of shares issued at the end of year. Where are we going to get this figure? Sometimes you'll be given information, but most of the times we chola lapha ezansi note number 7. Right, note number 7, ordinary share capital. Nalafu is one and the same thing. Number of shares issued at the end of year. End of year. Right. That's the first similarity. ASB is similarity. It's what you times by 100 over 1 times by 100 over 1 times by 100 over 1. There's another similarity, you see, among these ratios. Then into eyenzakalayo ke nansi ngifuna ungaclaim lama ratios, but try to understand. Let me just put this one aside ngizobe ngithathe le phela. Right. You see, a business, not a business, liya operator, not a business, liya operator. Right. Any business, this is a business. Right. Liya operator, a business, liya sebenza. Right. Sebenza kuna bantu la abane interest okuthiwa ngama stakeholders. That's an auditing now. We see, like next week we could be doing auditing. Right. We have abantu abane interest in our business called ama stakeholders. Right. Abantu abafana nani? Abafana no SARS, South African Revenue Services. Bekhona ini ama trade unions. Remember, SARS is only looking for 2 things. Right? Tax evasion as well as tax avoidance. Right? Whether you are paying a tax or you are dodging a tax. That's what they mean they're interested. Trade unions. Trade unions, they are only interested on 2 things. So on one thing, whether you are paying the workers, that is remuneration fairly, as well as safety working conditions at work. It can be also our competitors, people who have an interest in our business. We can have also our shareholders, the owners, shareholders. I'm driving this point to the ratios, right? We can have our creditors, right? People that supply us on credit. They want to check our credit worthiness, whether siyakwazi nokukhokha. Corner even commercial banks, accounting student for research, you see. There's directors, those are the people, those are the stakeholders, directors, as well as potential investors. But we're going to talk more when we are covering auditing. Point engizama ukuyisho la nansi mfundi ukuthi once thola imali, once we have sales, once we are done with the sales here, there's money now in the basket or in a kit, right? There's number one stakeholder among all these stakeholders, often simkhokhele, right? Otshobani uSARS. So we have to take in South Africa, it takes in 30% of our companies. Remember, we're dealing with the companies. So uSARS is number one stakeholder. As soon as the business get the money, umuntu oqala ofuneke bamqalaza ubani uSARS, South African Revenue Services. Never hambe bayokhokha lapha kwaSARS. So which means coming here, you see which in ratio it's earnings per share. We are not going to earn anything as shareholders, as directors, you see, unless otherwise we pay what to SARS. So in numerator there it's what? Net profit after tax. So which means here, you see, we are not going to earn up until we pay tax. So which means here we have what? Net profit after tax. And then you times by 100, your answer will be something cents. Or you can even put it in rents. So you see now we are done with the first ratio. Second ratio, guys, note number 7 and note number 8 ubaluleke kakhulu ku accounting. Angisho uyakhumbula lapha ku risk ratio nakho la ku risk ratio. Sithe non-current liability plus note number 7 as well as note number 8, right? Even here ku EPS, I mean like ku NAV. NAV we're going to deal with that, right? So dividends, so in the interim, or we call it paid. If we don't want to say interim, we can say it's a paid. Okay, it's a paid plus the final dividends, or declared, we call it declared or recommended, right? So what is the interim dividend? Yini interim dividend. Interim dividend, you see, as the business operates, you see, as the business operates, business operator lapha yabona. After 6 months of operations, sibone ukuthi asinayo imali. And let's put a smile on the face of our shareholders. We call that interim. You see, mhlawumbe nje ngasho ngesiZulu ukuthi hayi kuse umhlonyana noma kuse umemulo umshado seza. You see, it's just a start. You see, that is an interim. Let's say there will be food, and then you are just giving a start, just to start. You see, and then bese kuza in final dividends at the end. So we are at lapana your interim dividends plus your final. Where are you going to get these figures? You'll be giving these figures, or you're going to take it from note number 8. You're going to do note number 8 and note number 7 because it's in line with what we are doing now. Okay. And then the last ratio under the earnings groups, okay, under this group of the earnings. So nobody see the NAV, net asset value. So we have note number 7 plus note number 8. Remember, note number 7 and 8, even nalapha with risk ratio, note number 7 and 8, as you see, nala city, note number 7 and 8, divide by number of shares issued at the end, you times by 100, your answer will be something cents or rents. Nalapha put your answer will be something cents. You see, you are done with ama ratios okuyini ongama earnings. Then ke bese siya kuma ratio la hlupha kakhulu abantu ke okuthiwa ngama returns. So bese siqedile ke, then we can take some questions. Okay, let's go kuma returns. Okay, we said on the earnings we have the EPS, DPS, NAV. Uyabona? And these are the formulas. We are not going to earn anything unless otherwise we pay SARS. So we have net profit after tax. Sometimes you find that ukuthi sinikezwe net profit before tax or taxation. you must reverse and calculate net profit after tax. I'll show you towards the end. And then you divide by everything on this ratio. You must divide by what? A number of shares issued at the end. Then you times by 100 over 1. You get your answer in cents. You go to the dividends, interim dividends plus final dividends, divide by number of shares issued at the end. You times by 100. You get your answer in cents. NAV, right? Note number 7 and 8, right? Divide by shareholders, the number of shares issued. You times by 100, your answer will be something cents. And then you go to the ratios again, the one left, right? Remember we said kuma ratios you are allowed to abbreviate, look abbreviate on the ratios. There will be no marks that will be taken, right? The first ratio we are saying now we are dealing with what? Returns. Awu-2 kuphela nje guys ama-returns asinawo amanye. Yokuqala sithi return on shareholders return on shareholders equity, ROSH. They call it ROSH or ROSHE, right? ROSH or ROSHE. And then enye sinani return on total capital employed. We call it ROIS or ROSE, right? We call it ROIS or ROSE. These are the ratios. Maningi ama marks lama ratios la about 7 marks, 8 marks, 9 marks, 12 marks mabethandeni. So maningi kakhulu. Make sure ukuthi you understand ngoba asimile nawo anazinto ezisimile. Let me just ngibonise ukuthi alula kanjani. Yini into esimila la ama denominator akhona. So denominators are not the same but are almost the same. Denominator. Let's start with the denominator. Right? What is the denominator here? You go to the ROSH. You see? Note number 7. Note number 7 plus note number 8. What last year? Let's say, okay, about 7 and 8 go to ubaleki. Right? Note number 7 and 8. Simthola kuphi kwi-risk ratio. Nangu risk ratio yabona. Nangu liability is to 7 and 8. Siphinde futhi simthole kuphi kwi-NAV. Right? 7 and 8 is our numerator divided by number of shares issued. Also even nala kwi-ROSH na kwi-ROIS. Right? Let's say maybe we have 7 and 8. So 7 and 8 was last year. Let's say last year was 2020 plus 7 plus 8 was this year 2021. Uyabona certificate le uyayi-add uzoyidivide ngo2 ngoba sina 2 years. If besina 3 years you divide by 3. If besina 4 years you divide by 4. That's an average. Okay? You times here by what? 365, 366. But when I'm always opala this year, we're going to times it by 365. But last year, because it was a leap year, they were timesing by 366. Because it was a leap year, February, ubephela ngomhla 29. Akazi ukuphela ke this year, even next year ngomhla 29, we also aphele ngo-2024. But when I just stick on 365. Please don't use u12 lapha. Don't times it by 12. Abanye abafundi bayathanda ukutimesa ngo12, which means uma utimesa ngo12 i-answer yakho ngeke ibe right ngoba wena you are not using the actual days. You are assuming that all the months are ending on 30th. Okay. So we are saying we are looking at the similarities between these two ratios. So that you will understand these ratios on our crane. Right? And then again now we are done, okay, with the denominator and also even nalagwi ROS, we're going to times by 365, 366 over 1, right? And then your answer here before even we go, okay, we have the answer here. Okay, let me just talk about the answer when you are done. Let's go to iROIs. Also, iROIs is similar than the denominator yakwa Roche lapha ngenhla, but there's a slight difference, right? So here for last year 2020, right? So note number 7 plus note number 8 or last year lo yambona, plus non-current liability, plus non-current liability, right? So which means yabo lokhu okwa last year konke lokhu plus uza futhi na this year wenza the same thing. So u2021, right? Remember, in non-current liability, it's a loan or mortgage bond or mortgage loan. So 7, note number 7, that is the ordinary share capital, plus note number 8, that is retained income, plus in non-current liability. That is for 2021. Usuya add yabona ama figures amangaki? It's 1 2 3 1 2 3. So which means there are 6, right? You might have 6 figures here. If lama figures lawa u7 and 8 vele usebaliwe for you, so which means uzoba na 4 figures as a denominator, and then you must divide by 2. Uyabona? That is your figure there. And then again, now let's go to the numerators of these two ratios okuthiwa ngama returns, right? In numerator ye first ratio kunge iROSH noma iROSHE, right? Iyafana ne-EPS, right? iROSH, it's a big friend of the EPS. Okay, we are not going to earn up until we pay SARS. So here, if you get is net profit after tax. Net profit after tax. Then your answer is something percent. But my percentage is here because I'm returns now. So now the ratio net profit after tax divide by 7 and 8 for last year, 7 and 8 for this year. Don't forget to divide by 2. You times by 365 or 66 over 1. Then your answer would be something percent. That's a principle of no ibambe lapha mfundo. Ungayikhohlwa le ratio lena ngeke izisale. Otherwise ngoba kusiyona accounting without these two ratios, right? And then let's go to the second ratio, still on the returns, right? To our iROIs. Sithe lapha you can see ukuthi into ehlukayo laphana si add yini. Normally in non-current liability kusuke kuyi loan or mortgage bond, right? So we loan most of the time. Loan here, SEA or mortgage bond. Here says bala ini, says bala enumerator. Enumerator lapha, right? Enumerator ye ROIs, right? Or iROSE or return on total capital employed. It's an opposite of this one, right? You can see here we have a net profit after tax, last over nani, net profit before tax. Net profit before tax plus interest expense. Interest expense. Interest expense, it can be any interest of the liability. It can be interest on loan, interest on mortgage bond, interest on overdraft, interest on overdue creditors. As long as if it's an interest of the liability, you add there. But most of the time, so we interest on loan. Most of the time, so we interest on loan. And therefore, you times by 365 over 1, utholeke i-answer yakho ke laphana in terms of percentage. So the answer yakho in terms of percentage. So these are simple, these ratios, very simple. Let's have a look at the question. Again, especially for note number 7 and note number 8. So at least you'll see where do we get this 7 and 18, Yeah, especially 7 and 8 into engathi i-problem kakhulu la. Simple I mean these ratios kakhulu and bayathanda ukuthi bawabuze ke mfundi. Right? So here we are being told to prepare the following, right? Ordinary share capital, retained income, right? Look at your question there, right? It's a question paper le. In the question right kakhulu. Okay, let's do note number 7, note number 8. Okay, right. What is note number 7? Ordinary share capital. Ordinary share capital. Ordinary share capital. Ordinary share capital. Right. Ordinary share capital. Okay, we are told here, let's go and read what they are saying. You'll be having, we are told here, if we check it up on the parallel, on the across, right, good D, the company is authorized 5 million shares, right? Authorized. So how many shares that were authorized? Authorized shares. So how much shares are authorized? How much shares that is available for that financial year? So which means how much shares are corner in a basket or in a kitty? I'm 5 million. Ugutina, how are we going to split it? It's up to us, or it's up to the resolution. Maybe let's say we AGM would say, okay, that's what we're going to do. Okay, but again, this what is, I mean, that's what we have. 5 million. Okay, don't worry about the authorized. Our focus is on the issued. Right, issued at the beginning. So we have issued. Right, ordinary share issued at the beginning. Ordinary shares issued at beginning of the year. Right, so see, I check D. To the company is authorized 5 million shares. The average share price is 6 rand at the beginning of the year, financial year. So at the beginning of the year, we are given what? We are given 1 million. So which means we issued the shares are 1 million. We are given there 1 million get 0.06 in front. It's 160. And we are not given the price. Therefore, you go to the capital. Look at B. I'm on B. You are going to the capital, right? The capital year at the beginning of the year, 1370. Okay, that is our capital. You see, this is our capital there at the beginning of the year. And then we are also told that, okay, abona into eyenzakalayo la. Nansi into abayenzayo la. Into abayenzayo nansi, immediately after our beginning, there's buyback. Now, that is very tricky, but I will explain how to deal with this. So there's buyback. There's supposed to be during and then buyback. You see, so immediately here we have what? Buyback of shares. There were shares that were bought back. I'm 2 million. Right. Now my shares lapha athengiwe ango 2 million. Right? 200 shares were bought back. They were bought at what? At 9 rand purchase price. Okay, so that is a buyback of shares. Right, buyback of shares. Okay, nansi ke into ofuna siyazi mfundi, when you come to the shares and the buyback, right, fune uthi note number 7 plus note number 8 is equal to cash flow. That's why ama ratios ihlale hamba njalo ne cash flow, because khona ubudlelwano obukhona between ama ratio nane cash flow, especially on the buyback story. Note number 7 uyini, it's an average. Average. Note number 8 yini, retained So I'm not is note number 7. Sorry, remember note number 7. The name of note number 7 is what? Ordinary share capital. Ordinary share capital. Note number 8 is retained. Sorry, retained income. And then cash flow is cash flow, right? So we are saying here A plus B equal to C. So information uzonezwa u-A noma unezwa u-B noma unezwa u-C. Kufanele ukwazi ukuthi like uyithoyele wena okunye lokho oku2, right? So note number 7, it's average. So we are using an average here in terms of the buyback. And then here above note number 8, above average. And then note number 8, issued. So I mean the cash flow issued or any payment. Any payment. You see, it can be you are paying by using EFT or using a check, as long as if there's any payment or repurchased. Repurchased, because you cannot purchase without paying. Repurchased, right? So that is, so we are sitting here. So to our information to the average price. So we are given average. £6 average. So which means sila. And then we are told that shares were on sale for what? For R9. So which means sale, which means there was a purchase. They are saying here 200 shares were repurchased, certain shareholders at R9. So there was a repurchase, so R9. So R9. So which means retain ubani R3, because we are saying now R9 minus R6, you get what? R3. If you add these two, you're getting what? R9. If you are saying ordinary share capital plus retained income is equal. So which means in terms of buyback for note number 7, you'll be using R6. For note number 8, you'll be using R3. For cash flow, you'll be using what? R9. In number of shares, it will be the same. It will be just 200. Right? 200 shares, 200, not 2000, sorry, 200. Will be just 200. So which means here we have 200. So 1 million less 200, we get 800,000. You see, that is what ordinary share issued at the end of year, right? So we are already, remember we are doing note number 7. Note number 7, to our money, it's an average of R6. So for note number 7, we'll be always using what? Average. So which means here we times by R6. So now we are saying 200,000, 1, 2, 3, times by R6, times by 6. You get 120,000. So we have 120, 1.2, sorry, 1.2 million, right? 1.2 million, right? You must always less buyback, always either note number 7, note number 8, or buyback. So this one less 130, le figure engenhla 1, 2, 3. So labani 170,000. So that's the figure that we have here. That's the figure that we have. So for instance, remember so that's the number of shares issued at the end. If let's say we were doing on the same question, we have to do our earnings. We're going to divide by this number. All ratios now, ratios now our earnings. Bezobhala bani lo 800,000, because a number of shares issued at the end. I mean coming from note number 8. So bezobhala la, let me just use another marker here. Okay, I'll use the black. I need black here. That means this black. So which means there, bezodivide ngobani? Bezodivide go 800,000. Okay, I need black. Okay, 800,000. Wonke lama ratios lawa, because i-denominator corner is the same. Yabo? Nala futhi bezophinda sidivide ngobani? 800,000. Yabo? Nala futhi bezophinda futhi sidivide ngobani? Ngo-800,000. Already sesinayo ini ifigure yokuqala yabani ka note number 7. Nango 7 oqala mbona from capital 170. So which means here Note number 7 was to 170 plus le esingakabunayo note number 8. Let's go quickly to note number 8 because the question elandelayo ithi let's do note number 8. Okay, I hope ke uyabona ke lokho mfundi. Ngithi kuwena ilokuzana in terms of the buyback. Note number 7, it's an average. Note number 8, it's above the average or is more than the average. And then the cash flow is issued or payment or any repurchase or whatever method of payment. There are a lot of negotiable instruments that are being used nowadays to pay. People are paying by using stamps, paying by using checks, you see, as long as if it's a payment. So you're sitting here at C, A plus B equal to C. Question elandela iti calculator retained income. You can see the marks there, it's 8 marks and then 6 marks. Our marks are equal. Okay, let's go to note number 8. Let's go to note number 8. Note number 8, when also ama dividends, interim plus final. Right? So that is a retained income. What is a retained income? Lokho kuthiwa ama reserves, imali esalayo yabo retained. Yabo lakho umakhulu mangabe ekusavela imali ukuthi uhambe umzukulu uyofunda etertiary. Ama retained lawo, right? Uyakusavela umakhulu no mhlambe there's an amount of money at home, ama savings. You see, ama retained. Right? Or any business ya lokhuza iba nawo ama retained, a well run business. So we have a balance at the beginning. Balance at the beginning of year, right? What is the balance of the beginning of the year? So says here check lapha balance retained at the beginning of year. Nathi figure yakhona sinikeziwe eya last year. It's 1370, right? And then after this one, sine buyback, right, of shares. Mangathanda ukuthi buyback of shares ungathi repurchase of shares. And then after buyback we have what? Net profit after tax. After tax, right? And then sunani ke manje usuneme dividends. Dividends sine interim as well as final. Yabona ke, remember ngike ngakhuluma ngo interim and final lapha on the ratios. Kuma tuzana ku DPS akhumbula nakho lapha ngithe interim plus final, yabona? Divide by number of shares. The number of shares le okubani 800 simthole from note number 7. You times by 100, you get your answer in 2 cents. Right? This is what we are calculating now. So easy. The number of shares, so that the number of the buyback I change either from note number 7 or note number 8. Uyabona njengala angisho nakho la sithe inamba yakho ubani u200. Nala futhi note number 7 will be using u200. Even now we buyback futhi u200. Into eshintshayo ama splits, right? So we are saying you open the bracket here, you must disclose that one 200, right? Times sithe ubani split saka average u3 rand angishabo lapho u3 rand angishabona is 3 rand. So we're going to times u3 rand laphana. So 200 times u3 rand you get to 600,000. Right? In brackets. We always write a buyback in brackets. And then since you are checker in net profit after tax. You see we are given there net profit after tax now lapha 1,470,000, right? 1,470,000. Nansi lapha unikeziwe net profit after tax yakho, right? And then again from here usu calculator in manje your interim. Let's go and check bathini nge interim. Lapha ku E, but the interim dividends 15 cents per share was declared and paid. Yabona? The interim dividends, right? The interim dividend was declared and paid. The final dividends is 30 cents per share. i-final dividends u-30 cent per share. Interim dividends was declared and paid in August. Okay, in August. So easy. Usuya manje ku note number 7. Everything it depends lapha note number 7. Our interim nansi la mfundi. In this case, because i-buyback ila ezansi, we're going to take only this part. But if there was an issued, we're going to take the beginning plus issued. If there was issued, bangashongo lutho. Kodwa if bebethe shares are qualifying, I mean like where there's buyback, babhala ukuthi during the buyback of shares, the shares already qualifying for the final dividends. We'll be doing like we are doing. So which means you are timesing only 100. 100 times by 15 for the interim, divide by 100. Finally, final wethu nangu final wethu, because everything just goes up. So this plus this, so which means 100. We'll be saying. So here, okay, let's start with the interim. The interim, it's 1 million. Right? Oh, it's about 6. 1 million. 2, 4, 6. 1 million times by 15 divided by 100. Please, I'm saying to treat it as if I'm a percentage. So which means here for the interim, we're saying open brackets, right? 1 million, right? 1, 2, 3 times by 15 divided by 100. So you are getting now 150,000. Right? Final dividends, right? Because here, about showing good, okay, these shares do not qualify for the final dividend. So we're coming here at the end. You see? So, about showing good these shares. If we better these shares qualify for the final dividends, we're going to say this plus this. You see? So now, this is the final. So the interim is this one. The final is this one. So you times there by final, 30 cents. I must say, you must treat it as if it's percentages. So we are saying 800,000. 800,000 times by 30 divided by 100. So we punch calculator yakho. So it's 800,000 times by 30 divided by 100. So you get 240,000. You get 240,000 in fund. And then again now, we are add manje plus 150,000. So 390,000 in brackets. And then so in balance yakho at the end. Balance at the end of the year. I hope you mfundi wazile ukuthi ubone ama figures. Then usu add lanje le figure le minus le plus le minus le, you get the figure there at the end. You see, that's what you must do. I hope you wazile ukuthi ubone ukuthi ama ratios alinka kanjani with this note number 7 and 8. Siyabonga kakhulu mfundi. Utadishi nje uqhubeke uyimisele. Thank you.
Ningakhohlwa ukuthi nisengathokozela ezinye izifundo eziyisithupha kanye nezengeziwe i-Learner Wellness, i-Career Guidance kanye ne-Advanced Program. Hlanganyela nathi kwizifundo ezi-online ku-068 151 1072 noma ku-GoDigi@godigitalsa.today. Siyabonga.